Bloomberg Audio Studios. Podcasts, radio, news.
I'm Nathan Hager in New York, and we are getting some breaking economic data crossing the Bloomberg terminal. Personal Consumption Expenditures Price Index for February. This is the Fed's preferred gauge of inflation. It comes in at 2.8% on a year-over-year basis. That is the core deflator, which leaves out housing rents, which is very volatile in terms of the price pressures that we see. The personal income deflator for the month of February on a month-over-month basis comes in at 0.3%. That was just shy of what economists surveyed by Bloomberg were expecting on a 0.4% read. So that's unchanged from the month of January. Personal income comes in a little light at 0.3%. That's down from 1% in January. And personal spending comes in at 0.8%. That's quite a bit higher than economists surveyed by Bloomberg had been expecting, and a big jump from a 0.2% read in January. Let's bring in Bloomberg's international economics and policy correspondent, Mike McKee, with a little bit more context on these numbers. In terms of the PCE deflator, Mike, it looks like it comes in bang in line with expectations.
Well, the headline number is a little bit lower at 0.3 than was expected. 0.4 was the consensus, but of course, this is very tight numbers, and rounding is probably involved here. We did see inflation revised up on a month-over-month basis for January, from 0.3 to 0.4. So we do see a decline there in the month over month, but the year over year rises a little bit from 2.4 to 2.5%. That's probably base effects. The core comes in much lower than the prior month. In January, it was up 0.5%. Now it's only up 0.3. And the core deflator on a year over year basis is down a tick, 2.8% for 2.9%. So it's sort of a mixed picture here. In terms of prices, goods prices increased about 0.5%. Prices for services increased 0.3%. Now, goods prices had been the major deflationary force over the last several months. So the fact that goods prices increased, not particularly good news. We'll look for the breakdown on what happened there. Energy prices were up 2.3%. So that was the major problem, I think, with the good side. Food prices increased just 0.1%. So good news there. So it looks, Nathan, like a sort of a mixed picture. It is a little bit better than anticipated, but for the Fed, it is not enough to push them to want to make any changes in their timing for rate cuts.
Let's talk a little bit about the revisions as well, Mike. We've got those numbers just coming in as well.
Yes, as I mentioned, the personal spending numbers at 0.8 unrevised. Real personal spending, though, was revised a little bit lower from last month. Inflation-adjusted basis in January was down 0.2. It had originally been reported down 0.1, and now it's up 0.4 for February. So again, that is a good news number for the Fed and for probably the White House, because it shows that people are getting a little bit ahead of inflation.
So let's talk a little bit more about what's driving these latest numbers right now. You mentioned that the goods side of the inflation picture came in a little bit hotter. In terms of the fact that this seems to be coming in as a mixed read, what does that tell us about how the Fed could react?
Well, they're going to look past this. They're going to take it on board, but they don't meet again until May 1st. So they'll have another indicator for the March numbers just before their meeting at the end of March. And if they see this kind of progress, it's probably not going to be enough to get them to make any kind of moves in May. We're still seeing the inflation numbers a little bit on the high side for them. They use the PCE as their target, and their target, of course, 2%, and now they're 2.5%. So they'd want to see more progress there. They'd want to see more progress on the core deflator, because the only reason it looks better today is because it was revised up in January.
Bloomberg International Economics and Policy Correspondent Michael McKee with us as we continue to analyze this preferred gauge of inflation for the Federal Reserve, the PCE deflator, coming in a little bit hotter than expected with a 2.5% year over year read in terms of the headline number, and 0.3% also unchanged on a month-over-month basis from the month of January. Let's get some more analysis now. We're joined by Tom Porcelli, the chief US Economist at PGIM Fixed Income. Tom, great to have you with us on this Good Friday. Your reaction to these numbers?
Yeah, I mean, look, I think Mike, as always, nailed it. I mean, I think that it's sort of a mixed bag here. I think people will look at the spending number and I think, they'll say, hey, the consumer's really sort of crushing it here in Q1. But the reality is, I mean, this came with a drawdown in saving, an additional drawdown in saving, which is, again, it's sustainable only to a point. And so I don't like that you have this big burst in spending with income that was, sort of fairly modest. Now, again, I would say to the mixed bag idea, if you look at wages were pretty decent. But, the problem for me, and, this is something we've been flagging, if you just look at disposable income, right? I mean, that's really where the rubber meets the road on this. Disposable income, real disposable income to be specific. It's been flat. I mean, it fell slightly month on month in this report, but, it's been pretty flat now over the last couple of months. That, again, I think just speaks to sort of the long-term sustainability of sort of the kind of consumption numbers that we've seen over the last couple of quarters, which is to say we don't think, you're looking at a sort of a ripping backdrop here. I mean, I think things are just sort of moving along at a sort of a decent pace. It's been our call, that 24 would be a pretty reasonable year from a growth perspective. But I think there's enough in here and enough been happening that we sort of wonder about the ability for the consumer to really sort of press this meaningfully more from here. The last thing I'll say on the inflation numbers, look, I think they basically came in as was expected, particularly on the core. Core was at 0.3, and it rounded up to 0.3. It was actually 0.26 for whatever that's worth. But I think this is the kind of movement that we've been expecting. I think this is the kind of movement that the Fed continues to expect. So I think on balance, there's no big surprises here. I mean, I think whatever you thought about sort of the backdrop before this number, I think you're going to continue to think that.
I want to jump in, Tom, with a couple of numbers to bring people up to speed on some of the things that you're saying here. Wages and salaries were up 0.8, which is a very large gain after 0.3 in January. Interestingly enough, because the market has risen so much, we should have seen, I would have thought, more income on assets, but personal interest income fell 0.4 and dividend income down by 3.7%. So I guess people aren't selling at this point. They're just reinvesting. You mentioned the real personal disposable income. It was down 0.1 after being flat last month. That's the first decline since September. So you're right about the issue here of whether or not we're seeing people continually able to spend. It looks like from their wages and salaries, they can. You mentioned the savings rate, 3.6% compared to 4.1%. Which is more important, the savings rate or raises in your weekly paycheck?
Yeah, I mean, they obviously both matter. I mean, they matter for different reasons, though. I think that's a really important idea. It's great that we continue to see income at large, right, through wages, through the wage channel, continue to move along at a pretty reasonable pace. But again, I think, we're trying to think big picture here. So the big picture thesis is, well, look, how has the consumer been driving spending? And they've been driving spending through a combination of drawing down saving. And again, we're not talking about the excess saving thing, right? That story's long since gone. But, what we're talking about now is cutting into the muscle of saving. And so if you look at, sort of the bottom 99%, right? So just excluding the top 1%, what you'd see is that saving is now below where you would have been in a sort of a pre-COVID baseline estimate. That to me is noteworthy. And then you have to also consider the sort of the other channel through which the consumer has really been able to sort of drive spending, and that's through credit usage, which again, these are things that can persist That this is not necessarily the healthiest way of doing that spending.
And just to reiterate, the Fed's preferred gauge of underlying inflation did cool last month after an even bigger January increase when you factor in the revisions. The core personal consumption expenditures price index, stripping out food and energy, increased 0.3% from January, following a 0.5% reading in January. That was the biggest back-to-back gain in a year, 2.8% on a year-over-year basis. I'm Nathan Hager in New York with more analysis of these inflation numbers and talking about the spending that we continue to see in this economy, the consumer continuing to hold up. Is there still a concern, Tom, that is being driven by credit card usage, by pulling into debt? And can savings bolster that when we have the kind of elevated interest rates that we're seeing in this economy right now?
Yeah, it can persist. I mean, we've seen this right historically. To save, if the consumer wants, they could draw down saving to zero. And we're 3.6%. So it can certainly happen, and I think it can persist. And I think, if I think about our forecast for this year and even into next year, I think you're looking at a sort of, what will be sort of a trend-like growth. So I have no challenge with the actual numbers. What I have a challenge with is how it's being achieved. Because that's not enduring, right? I mean, you don't generate an enduring, /lasting economic expansion when that's doing the driving. I think what we need to really look to is the sort of the labor backdrop. And look, I think that there's certainly some slowing that's taking place in pockets of the labor backdrop. I think that's been pretty apparent now for the last handful of months. I am encouraged by the wages and salaries increase. We'll want to dig into that more just to sort of see what the details were on the back of this number. But that kind of story for us really sort of fits snugly into our view. I mean, we think you can easily run at a 1.5% to 2% pace this year, and I don't see any reason to sort of alter that view at this point.
We had a little something here on the markets because we talked about how dividend and interest income was down during the month. We also see that the contributions to inflation from Wall Street are down significantly, I guess, because maybe everybody's just reinvesting and not taking profits. But financial services, fees and commissions just up 0.1% after rising more than 2% last month. So a little bit less inflation pressure coming out of Wall Street, what we had called the pogo problem. As we do well on Wall Street, it increases inflation. But that brings up another question for you, Tom, and that is the wealth effect. The Fed worries that the wealth effect is going to drive the economy longer. Do we see that really from the gains that we have seen in equity markets? Are people out spending that money, or is that a subset of people who are making money who don't really have a marginal propensity to consume that is all that very high?
So I will say that I believe in the wealth effect in the extremes. And I think it's very fair to say that we're in an extreme. I mean, if you think about sort of the single biggest asset for most people in this country, the single biggest asset is their house. And I think what people see is that their home prices have accelerated and accelerated in a very notable way. And I don't doubt for a second that feeds into this sort of, hey, I'm actually doing pretty good here. And that emboldens people to continue to go out and feel comfortable spending. Of course, I think what we have to recognize is it's great that home prices have risen as much as they have, but any of that home equity is trapped, right? It's trapped because we're in a higher rate environment, and it becomes incredibly complicated or very expensive for people to basically extract that money. So, I'd be careful with that idea. I mean. Again, I don't doubt for a second that it's happening, but it's paper wealth because of high rates. No one can extract any of that.
And Tom, as you know, we're going to be hearing from Chairman Powell in just a couple hours here, 11:30 a.m. Wall Street time. He's going to be taking part in a moderated discussion. Do you expect these numbers are really going to change the message that we hear from Powell, as he's sounded at least a little bit more comfortable with the way the inflation roadmap has been going up to this point?
Yeah, it's a resounding no. I mean, these numbers will not change anything for Powell. He literally just spoke. There'll be no reason for him to alter any of his messaging. I think, this is something that they were looking for, particularly this core deflator, hovering here now at 2.8. I think that this is the path that they were expecting from an inflation perspective. And again, I think the one thing that really came through very loud and clear during his last press conference was this idea of over time, right? He kept on saying, in fact, I think he literally even said, we stress over time, inflation will improve. And he said that multiple times. And I think that fits very nicely with the numbers that we just saw. It is continuing to improve over time. I think the other thing that was really interesting, and this is probably more micro, but on Powell, I thought it was really interesting that he acknowledged sort of these base effects that we're going to start to bump up against in the second half of the year. It's going to be a challenge for inflation to really improve in earnest from a month-on-month perspective, because you're going to have these these unfavorable year-ago comps in the second half of the year. So if you think about, sort of the direction of inflation, you'll continue to drift lower. I mean, here we are at 2.8 rounds up to 2.8. And I think you'll get probably down to around 2.4-ish in the next few months. But as you roll into the second half of the year, it's going to start to accelerate again. You can get easily back up to about 2.7% after hitting 2.4% around middle of the year just because of comps. And one of the reasons why I love that he said that is because he's, I think, trying to preempt what could be what will be a conversation around, hey, but inflation is accelerating again. But again, it's important to note that it's a comp challenge. And just to be clear, just to make sure this is abundantly clear, if you print 0.2 month on month between now and the end of the year, that's how those year-ago comps will unfold. You'll get down to as low as 2.4, and then you can get bounce back up to around 2.7. So I like that he's sort of, trying to draw attention to that. But again, yes. The short answer to your question is no. I don't think that there's anything here that will alter his view on what he already said.
And we will get that message at 11:30 a.m. Wall Street time, live coverage of Chairman Powell's moderated remarks at the San Francisco Fed later on this morning. Tom, thanks for being with us as we dig a little deeper into this latest inflation data. Tom Porcelli there, the chief U.S. economist at PGIM Fixed Income. And I'm Nathan Hager, along with Bloomberg International Economics and Policy correspondent Michael McKee. As we continue to get some more analysis of the PCE deflator, we're joined now by Sarah House, the senior economist at Wells Fargo. So it seems, Sarah, a bit of a mixed bag. The bumpy road to disinflation seems to continue following these numbers. Your thoughts?
Yeah, I think that's right, especially when we look at inflation. So we did see some bumps in terms of the underlying movers shift around a bit. So this month we actually saw some more moderation in terms of the services side, but you did see the goods inflation pick up a little bit on a month-over-month basis, which, again, I think just speaks to that month-to-month you are going to see some volatility in these numbers. But I think overall you're still seeing signs of at least the overall trend grinding lower, but it's certainly a slow grind that we're seeing.
So it's Michael McKee. I'm looking at the super core number for PCE. We haven't talked about that yet this morning. And on a month-over-month basis, it's up by 0.2 after a 0.7 gain the month before. So that's probably going to make the Fed and Jay Powell happy, because they've been particularly worried about services prices.
Yeah, I think that's at least one of the more encouraging developments of this morning's data in terms of the inflation trajectory. But when we think about the services side, we really do need this to start chipping in more. So we've had significant goods disinflation over the past year. So if you look at just the change in the year-over-year rates of inflation, basically 2/3 of it has 2/3 of the decline has come from the goods side. And so given how big a share services is, we need to see that decelerate more. So this is a good month, but the Fed's certainly going to need to see more months like this in terms of that services inflation subsiding a little bit.
Well, what's the outlook then about whether we are going to see more months like this? Something else we haven't talked about is the disruption at the Port of Baltimore after the bridge collapse. And think about what effect that could have on goods inflation down the line. I mean, is that something that we can factor in at this point?
I think it's really hard to put a number around what that's going to do, but I think it certainly doesn't help in terms of seeing further goods deflation or at least a still pretty low rate of goods inflation. So it's just one more hurdle. We've seen a lot of the benefits from the initial unwinding of supply chains already feed through, and we look at even before we saw this Baltimore bridge collapse, that supply chain pressures have really neutralized. So I think when we look out over the course of this year, you aren't going to see as much help coming from the goods side in terms of the core. And so again, that means that services are going to have to pick up the baton, and we are going to need to see more disinflation coming from the services side if we're going to keep moving back towards 2%.
So is there much more that the Fed can do to get that services side of the equation down?
I think so. They've had a lot of help in terms of the supply side on services too. When we think about the labor market and just how much we've seen labor force growth improve, and that's been a big help in terms of reducing those wage pressures. But when we look at some of the wage numbers, they're getting close to where the Fed would need them to be, but not there yet, and where we still haven't hit 2% inflation, let alone on a sustained basis. I think this is going to be a waiting game. So we've already seen expectations for any easing get pushed out a little bit, and I think until we see, I think, more improvement on the services side, it's going to continue to be a matter of so do you get that timing of when the Fed begins to cut rates, start pushing back and see that even move further.
So can you say at this point whether a read like this will change the equation in terms of what the Fed is thinking about the rate path at this point? I mean, they've already penciled in, I think in the dot plot, the median is still 3. I mean, does that really change things after a reading like this?
I don't think so. I mean, especially if we're focused on inflation, that came in pretty much in line. Sure, it was a touch softer if we're going out to 2 decimals, but it came on top of the upward revisions of January. So it doesn't really change the picture. And at the end of the day, you still have consumers that are out there willing to spend. And so that's going to make it harder for that demand side to chip in and help drive inflation lower, as we maybe are seeing some of the supply side benefits begin to fade this year as we have seen much more normalization in supply chains. And I think you're going to get only more incremental growth in labor supply after 2 big years of labor force growth.
We did see some improvement, very small improvement, but improvement in housing prices in PCE of 0.4 for the month after a 0.5 gain last month. So I guess I would ask, partly from your national experience, Sarah, but also from being in the Charlotte area, which has been a hot real estate area, are we finally going to start to see the declines that the Fed has been looking for in housing?
I think there's still some room to go in terms of the housing disinflation story. So obviously that's been a big part of the stronger prints to start the year, even as, again, we did see a little bit more moderation in the February numbers here today. But I think when we look at everything that we're seeing in terms of the private sector measures, that there is still more disinflation in trying to come in housing. I think the big question is the magnitude of how much further that falls, and of course some of the timing. So I think we feel pretty confident in the direction. The Fed, it seems like Chair Powell feels pretty confident in the direction. He spoke to that specifically in his press conference, but there's still a lot of questions around the timing. And if it takes too long and you start to see that impulse from the downward impulse from goods deflation begin to peter out, that's going to be a contributing factor to inflation being a bit stickier as we move through this year.
Well, let me circle back to one more thing before we let you go here, and that is personal income. Wages and salaries up 0.8% after just 0.3 in January. Does that tell you anything in particular? Is that noise, or are companies having to pay up more to attract workers with still a strong labor market?
Yeah, so I think that's reflective of the fact that we did see another strong month of hiring in February, and you saw the work week pick up too. So I think overall that's reflecting that the labor market is still strong. This is really important for the durability of consumer spending ahead, even if it looks like consumers were having to save a little bit less to fund their outlays in February. But I think that's one of the bright spots in terms of seeing this economy continue to expand and deal with these higher interest rates, is if the labor market continues to chug along, that's going to be helpful for the bulk of consumers.
Sarah, we're in this unusual circumstance where all this data are coming out on a holiday. The stock trading and the bond markets are both closed for Good Friday. What kind of market reaction can we expect to data like this when the markets finally open on Monday?
Yeah, so I think on net, this shows that the consumer is still out there spending. It's no shrinking violet, and so I think that does question how much the demand side is going to help bring inflation lower, and so I think that's maybe the most important takeaway from today's report, considering that the inflation numbers came in essentially as expected.
And so what kind of do you expect then that we could see bond volatility when the markets reopen on Monday?
Well, they'll have some time to digest this. I mean, I think it's also going to depend on what we hear from Powell this afternoon. So we'll see if he makes waves. I think he tries not to, but I think it'll be a combination of both today's numbers and what the chair has to say.
Yeah, and again, we are going to have those comments from Chairman Powell, 11:30 a.m. Wall Street time here on Bloomberg Radio in that moderated discussion hosted by the San Francisco Fed. I asked Tom earlier if you're expecting any change to the messaging. Do you expect that we'll hear much change from Chairman Powell after this inflation data?
I don't think so, considering that, again, the inflation data was pretty much spot on line with expectations going in once you mapped both the CPI and PPI data, and it hasn't been that long since he spoke before. So I think we're going to continue to hear him say that they need to see more confidence that yes, they're looking for inflation to come down over time, but I think in the immediate term there's still no catalyst, I think, for moving imminently here.
Appreciate this, Sarah. Thanks for coming on with us on a market holiday. Sarah House there, a senior economist at Wells Fargo, as we continue to digest this preferred inflation gauge for the Federal Reserve, the PCE deflator, coming in, as you mentioned, Mike, with a little bit of a mixed bag, kind of in line on a year-over-year basis, but some slight cooling month over month.
Yeah, it's not the kind of thing that, as Sarah said, would change the Fed's mind. It would be considered relatively good news for the Fed in terms of continued progress on inflation, but as you mentioned, continued slow and bumpy progress on inflation.
Yeah, it seems like that last mile, as the Fed has been reiterating for quite some time, that last mile is going to be quite a ways to go in terms of getting inflation back down to that 2% target, of course, that the Fed has been talking about now for months as we've continued to watch this inflation journey go on to try to get these price pressures back under control. And again, with the PCE data coming out this morning, slightly cooler than a lot of economists have been expecting, particularly on a month-over-month basis when you factor in the revisions for January that had come in even bigger than expected. 0.3% increase month-over-month on the headline PCE deflator and 2.8% year-over-year. I'm sorry, 2.5% for the headline. It was 2.8% year-over-year when you strip out the food and energy from the PCE deflator. You've been listening to live coverage of this economic data, the Fed's preferred inflation gauge, coming in with a bit of a mixed bag. I'm Nathan Hager alongside Bloomberg International Economics and Policy correspondent Michael McKee. Stay with us. Your top business headlines and global news stories are coming up right now.